Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew Meredith, thanks for taking the time out to join me for week 2, mate.
Thanks for having me again.
Yeah.
Same place.
Same place, mate. Same place.
Background. Nothing's changed.
Yeah, I got some feedback that the light was on behind me last time, so I've fixed that up. Looks like you've got a new shirt and a whiteboard.
New shirt, but I think it fits a bit better this time, hopefully.
Full of ideas on that whiteboard too, by the looks of it.
Very soon.
Yeah.
It's a job for the weekend.
Work in progress. Looks great, mate. So this week we thought we'd, instead of having one company each, we would have 2, maybe be a bit quicker, a bit more concise. And then at the end, we'll kind of provide some things that we're looking forward to or things that have caught our attention. We've got 2 retailers and 2 tech companies, although both of the retailers actually have a pretty strong tech online presence these days, just to say. So it's an exciting chat. Maybe you go first. Got a bit of a blue chip first up.
Blue chip, yeah, maybe modern day blue chip. I took a look at JB Hi-Fi during the week. Market responded pretty well to their result. I think sales were up about 12%. Profit was up about 33%, just above analyst expectations. And then I'm starting to call them the new dividend play. They boosted their dividend by 33%.
Yeah,
and
wow.
now it's about a 3.5% yield, which is probably better than Westpac, unfortunately, for bank shareholders. What did you think of the result that came out?
Yeah, well, I thought, it's pretty resilient, right? Like we think retailers, it's bad news when stores close. At least here in Victoria, you think, our little bubble with restrictions and what have you, you think this is going to be a pretty bad time for them. But a lot of these retailers, and particularly like what you might call a big box retailer, a retailer that has a lot of, latency in this floor space, can offer an online product and can really just tap into those stimulus checks, really, when you think about it. I thought, JB, there are a few others that stand out, like Temple and Webster, a few retailers like this that are kind of like in the box seat for increased sales at the moment. But yeah. I'm sure you've got a few other headlines in there to get through.
Yeah, I noticed on the front page they said Australians usually spend about 100 billion a year on travel. And as we're kind of seeing, that's all being diverted to either JB Hi-Fi or Bunnings.
Yeah.
So it's kind of had this great tailwind. And then as you were mentioning, I think a lot of people don't realise, though everyone was worried when Amazon came in that JB Hi-Fi would disappear, but they've actually, the share price almost doubled since Amazon started. And that's because they're a completely different model, as you were kind of alluding to. They don't run warehouses. Their stores look messy and crazy because that is their warehouse. They don't have the additional overheads and costs that go with having a central system anywhere. And that probably brought in the core part of my kind of 3 takeaways from the report, which is their cost of doing business is 14%, compared to, if you look at Best Buy, which would be probably 10 times bigger, one of the big electronics retailers in the US, that's 16%. So this is one of the lowest cost retailing businesses probably around the world at the moment. And that converts into my favorite ratio. I'm not sure what you think about return on invested capital.
Yep.
So 50% return on invested capital, which means every dollar that you're investing is getting a 50% return on it, basically. You can't find that in many other businesses, can you?
No, well, it's pretty rare, particularly, when you look at retailers, you think capital intensity. So you think that capital element of that ratio is going to blow out. But it's pretty impressive. And JB's been like that for a very long time. I think it's kind of kept naysayers at bay, just pointing them to the return on invested capital.
Yeah, exactly. And it started off in a garage in, I think it was Rowville or in the eastern suburbs of Melbourne somewhere. And the big one I saw was that online sales grew quickly. Fair enough, 40 something percent, but it's only 7.5% of their total sales. So it's similar to the Bunnings West Farmers story. where they benefited from work from home, but they've still got huge capacity in their online distribution. And if you look at their website, a little bit of white space probably wouldn't go astray in getting a few more sales, but that kind of stands out as an opportunity for me. What do you think?
Yeah, I think this is the thing, right? Some of the businesses have really struggled to adapt to online. Maybe I won't name names, but we're looking for some white goods at the moment, and you try and give them a call, or you try to speak to someone online, and it might be half an hour before someone picks up the phone. And I know they're trying to deal with these things, but the ability to have an established online sales funnel, which JB did prior to COVID, I think has set it in good stead here. And so, yeah, I tend to agree. I mean, this is going to be a competitive space as companies shift online or are forced to shift online. But I think too, JB's kind of got a little bit of a head start here on some of the competitors, some of the big name competitors in particular, who you might associate alongside JB for electronics and those types of things. So, yeah, I mean, that's probably a pretty big opportunity for the business. I mean, it's pretty hard to haggle online too, as I'm discovering. So maybe margins improve. No,
you can try to send a couple of emails or text messages, and
yeah, it's pretty hard to offer them 20% less in online chat. I mean, it's not much emotion. Yeah, that's it. It just doesn't work. So I think together with, like you said, that floor space, the way the distribution network is set up, the established online model, I think that's a pretty impressive part of their business, and one you'd expect to grow for quite a while yet.
I think the option to get out of that waiting for Australia Post to deliver. We know Australia Post is doing incredibly well. All my packages come pretty quickly, but different businesses can take a week, 2 weeks, 3 weeks. So the option to go to a Good Guys or a JB Hi-Fi store, which are usually less than 3 or 4 kilometers from your house anyway, and pick it up rather than waiting, so you can get things immediately. Probably the only thing I'd be wary of at the moment was the potential that some of the sales have been brought forward, and I think that's something that management highlighted. They said, I think year-on-year sales growth was something like 40% in July. So there's some potential that maybe everyone's brought forward their spending for Christmas. On the other hand, if there's $100 billion in travel spend, well, maybe they can find more things to buy. Then I'm not sure if you're a gamer or not. FIFA, NBA, all the big titles. So most of them have been deferred. And part of if you call 12% increase in sales week, part of that was due to the software and gaming reducing during the year. So I wouldn't be surprised with FIFA, NBA, Madden, all these new titles due out towards the end of this year that sales actually pick up unexpectedly.
Yeah, that's an interesting one, because in the short term, I tend to agree with you, but longer term, I think with some of the newer version consoles, and if you couldn't tell, I do like a bit of gaming every now and again. With the newer version consoles, I guess they're trying to go around the retailers, and they're trying to force the gamers of whether it's PlayStation or Xbox or whatever. They're trying to encourage online downloads. So more games become this kind of subscription-based model or free-to-play model where you buy things in the game. And I think longer term that could be a bit of a drag on sales for companies like JB, but in the short term, absolutely. I mean, it's almost religious if you're a soccer fan that you go out and buy the latest title of FIFA. It's probably one of the most resilient games I've ever seen.
Franchise in history.
Yeah, that's it. Yeah, and together with like NBA 2K, I mean, these games are money for jam. You just put the CD on the shelf and it sells. So, I tend to agree with you there.
I mean, you're getting both PlayStation and Xbox consoles out later this year too. So, I'm not sure whether our analyst partners are as much gamers as us, so they may not realise those things are ahead as well.
Yeah, true. That's again, like, you've got to buy the hardware from somewhere, so you're definitely going to pay. There's going to be some capital saved. Yeah. So how about this one then, mate? As we come to the end of it, would you give it a buy, hold, or sell if I forced you to pick one?
I thought it was going to be on a 30, 40 times multiple, but it's only on 20. But I think given how fast growth's been, it's got to be a hold for the moment. Yeah.
And I tend to agree with you there. I think, the problem is that these businesses become fully priced pretty quickly. And I think, as we'll get to in a moment, there are some businesses a little bit maybe further down the market cap spectrum, which are pretty interesting right now if you're looking for that online exposure. One of the businesses that I've got, which would be familiar to almost everyone, in Australia, seeing that it has now over 2.3 million active users, is Kogan. So ticker code KGN. Most people will know Kogan. It's got a pretty iconic founder, Ruslan Kogan. It's kind of a do anything online retail store. So you could go there, you could buy insurance, you could get your internet sorted, your phone, you could probably buy a car, pretty much anything that you want, you can find on Kogan. And I think it's kind of the Australian version of the everything store or Amazon. So, I mean, I was fortunate to see Ruslan do a kind of informal presentation earlier this year. And just the way he speaks, you can see how passionate he is about the customer experience and about delivering a product to people quickly, get the right product to them, and then also with the online experience, matching the right products to the right people to increase the velocity. And I mean,
he's got the Jeff Bezos kind of approach.
That's it. And I think it's one of those things where for so many years, online retailing was, and online e-com just in general, I guess, was kind of the thing that, you know, the early adopters did. And then there was kind of this majority, but it was really a thing that, you know, the new age people did. And now we're starting to see with COVID and the like that more people are going to accept online shopping as their kind of their first point of call. And it's interesting because Kogan actually has a new membership service, which is Kogan First. And it kind of says it in the name that it's basically their version of Prime. And you can pick it up for around about $99 a year and you get, you know, the quick delivery, the better customer service and all that type of thing versus say Amazon, which is $66. But anyway, I'm getting a bit ahead of myself. What I found interesting, Drew, about Kogan is that you have to look back into 2016 and you see that the shares were trading below $1.50 and they're about $22. And this is a business that was already quite well established. So yeah, I mean,
it's insane the trajectory of that.
Yeah, and it's a business that most people wrote off, to be honest, because most people thought, like JB, they thought the business is just going to get smashed when Amazon gets here. I think quite a few years ago, one of the leaders at Wesfarmers, Richard Goyder, said, you know, the biggest threat that we see is Amazon. And this was around the time that Kogan listed. And I thought to myself, well, this is the biggest retailer in the country, or one of the biggest retailers in the country, saying, watch out for this guy. And then Kogan comes on the scene. But I mean, it's kind of throwing caution to the wind. Revenue was up. If I just get some headline figures here, Drew, revenue was up 13%, 497 million. Profit before tax up 66%. So pretty impressive figures there. A dividend, which most people, I guess, don't really associate. They don't really associate it. But final dividend of 8.2 cents. I think analysts were expecting about 14. So the full year dividends were 13.5. So it was I guess analysts, you know, we often say that, you know, it failed to meet expectations, but maybe it's the other way around. Maybe analysts just got it wrong. So it was slightly below what analysts had expected. Profit was, again, slightly below what analysts had expected. But, I mean, all things considered, the key takeaway for me, Drew, the first one was the headline that management actually came out with. So I don't know how this goes on. Maybe you can shed some light here. But do companies get to choose how a headline presents on the ASX, or is that because you always see like final version, volume 6 or whatever it is?
They usually pay thousands of dollars for a graphic design or some sort of marketing agency, don't they, to think of something intelligent?
I'm sure there's a PR agency out there that came up with this one, but the headline was Kogan.com shines through adversity as preparation meets opportunity. And if you think about it, Kogan's been operating for around about 15 years, right? And now is when we're starting to see so much of this demand come onto the platform. One of the things that struck me under this headline was that was a quote from Ruslan Kogan, who said that the first-time purchasers on the platform are now making repeat purchases 40% faster. So it's saying that once they're already on, they've accepted it, they trust the website to get their products and hand over their credit card information. And that velocity, again, it comes back to that. They're spending more, or at least they're not per transaction, but more times, more frequently. And that's really the essence of this business, I think, longer term. If they can just push more revenue through the funnel, more sales, more revenue, what you will see is that you'll see that free cash flow just pour out the other side.
And I've seen some ads on TV for the first time I think the first time ever for Kogan.
Yeah, right.
Pretty well designed ads as well.
Yeah, this is the thing. Like, you can go there now and you can get anything. I was trying to look for headlines that were trying to focus on specific products. If you could go back maybe 5 years ago, and there would be a market sensitive announcement every time Kogan announced a new vertical. But there's just so many now that it's kind of taken away from that. But if I could maybe come up with one of the I guess innovations, if you like, is this Kogan First membership, and it's all about building that loyalty with the customer base. I couldn't find any specific numbers on this, but what I did see from a very basic chart that management provided was that in the second half of the financial year, Kogan First memberships were new Kogan First memberships, which are paying memberships for $99, 3 times higher than the first half of the financial year. So it serves to give you an idea of, I guess, how fast this thing is spinning up. And then, post June 30, they even came out and said that, hey, revenue's way up, activity on the site's way up. All these different metrics are way up. So it hasn't stopped at June 30, although that's when the accounts stopped. So
fastest growing 15-year-old company.
That's it, yeah. And I guess shareholders have been really well rewarded for their patience there too.
You're not worried about dilution?
Yeah.
With so many verticals, are you kind of insurance, energy, super? I kind of sit there and go, surely you just focus on product?
Yeah, I guess that's one of those things, right, where, like I said, maybe 3 or 4 years ago, you would maybe be a bit dubious with it all. You think, how can they possibly do this, that, and the other? But I think their systems are so well, I guess, trotted now that they can just tack this on and see how it goes. And if it doesn't work, it just moves aside and then the next thing comes in. But I think the core business of Kogan is still really impressive. There was another data point that I have here, Drew, which was basically to say that the average purchase price is still in the hundreds of dollars. So even though they're adding these, get your mobile phone, get your internet, get whatever, there's still a lot of, in every customer's cart, there's still a lot going through the platform, and that's been pretty consistent through time. So it's not, for me, it's not so much worrying to see them offering these kind of adjunct little verticals, but I guess the core metric that I'd be watching there is, I guess, the basket size in addition to all the traffic that comes through the site. But there was one last thing I just wanted to get through in the numbers here, which is just free cash flow, which I calculated to be about 37 million, up from negative. So it's quite a jump.
Always positive.
Yeah, that's it. And so that's just hinting at that operating leverage, which comes through with more volume going through the platform. Got a lot of cash in the bank, which didn't include the share purchase plan at 146 million. No bank debt, I believe. We've obviously got the new lease changes, but that's something for another time. So ultimately, I think I'll be watching website traffic, what they do with all this cash flow, like where it goes. Obviously, a dividend's nice, but what else happens? You mentioned return on invested capital, so that's something. And Kogan First, I just want to see more growth in that. I think with Amazon Prime, I'm an Amazon Prime member. Are you an Amazon Prime member?
I do. I tried it for a week or two, but then I ordered on Amazon and the same package came in a day anyway. So.
Okay. Well, I'm definitely one. So I think the way we shop is going to change. I made a quip on Twitter the other day. I said, we call it online shopping, but when our kids are grown up, we're not going to call it online shopping. We're going to call it shopping, because the way we think about it today is going to be different to how we think about it in the future. And I think there's only going to be more of this. And I think this has pretty significant implications for all different types of e-commerce businesses. But if you look, say, at Mercado Libre in South America, Amazon in North America, and right around the world, what you find is that the mix of how e-commerce is done is changing. And soon it will become a place where people don't even go to Google to search for a product. They just go to the supermarket that's in their pocket, which is Amazon or Kogan. And I think that's a powerful thing. And the way you get to that is you build extreme customer loyalty. And I think Kogan's doing that. So I guess it all comes back to price and value. I'd like to know the business more before I go out and say it's a buy, hold, or sell. But if I was anywhere, it'd probably be a small piece for a portfolio, maybe on the hold side of things, to sit on the fence a little bit, Drew, mate. How about yourself?
I saw the two founders were selling this week, a couple of 100 million maybe. So yeah, I'm going to go with them at this valuation, maybe similar to JB Hi-Fi. Some sales have been brought forward, but otherwise an incredible business. It's a sell. at the moment, but a good business. You know, it's
Yeah.
more of a sell to lock in profits.
Yeah, that's a good point. I mean, I got spooked, and I wrote quite a scathing article about this not too long ago when the founders sold down, and I just didn't like the rhetoric and the commentary around it.
Yeah.
I mean, you know, directors buy for one reason, sell for many, right? And I think if they could look back in time, they'd probably be kicking themselves for selling a couple of years ago. Yeah, that's it. So who knows? But that's an interesting business. It's definitely one for the watch list for me, at least.
Yeah, definitely. Love the business as well.
Mm. How about you, mate? What's number 2?
We went into the small cap space, which I thought was a gift card provider. Maybe it's not small cap anymore. It's about $1 billion market cap. So that probably brings it into mid caps. EML Payments. Have you heard of EML?
Absolutely. Run the rule over it a few times. Yep.
Yeah. You're not a holder or anything?
No, missed my opportunity.
Yeah. Yeah, so I originally thought they were all gift cards, you know, the prepaid cards you see at 7-Eleven or the supermarket. But it turns out we could be one of the biggest users of their reloadable cards along with their gift cards, because they've kind of pivoted into, if anyone's in not-for-profit or medical land, salary packaging cards. So my wife's in medicine and she is employed by 2 or 3 different hospitals every year. Which means she gets 3 different salary packaging cards. I think all of them are issued by EML. So their results were pretty solid. The share price is down, I think, about close to 10% this week, though. Volumes were up 54%, so that's the total amount of funds that were going on to all their different types of cards. Revenue was up 25%. And profit, which you don't hear very often for a fintech, up 17% to 24 million. It's very weird. They call themselves the fintech to fintechs because they've been pivoting their business a lot, one into these reloadable cards, but also into providing kind of solutions for some cryptocurrency platforms. If you want to get cash out of your crypto onto a card, and also we don't like to talk about it, but Ladbrokes and kind of some of the gambling businesses where you can almost have an FPOS card that comes straight out of your betting account. You don't have any of those?
No, I don't. I was going to say, mate, maybe for those of us that don't do salary packaging, can you explain how that works with the card?
Oh, yeah. So basically, salary packaging, I won't go too specific, you can put up to about $10,000 of pre-tax money onto a card that can then be used for either meal and entertainment expenses or for mortgage repayments and rental payments. So basically, your employer pays the salary packaging company who loads your card on a fortnightly basis. So it's very recurring revenue, and once you're in the industries of medicine and not-for-profit, you rarely leave them. So kind of sticky customer base. So they're contracted with Macmillan Shakespeare, so ASX listed, and Smart Group as well, I think. And so it's still the prepaid cards. It's about 60% of their revenue. But this reloadable is kind of pushing up very quickly at about 30 or 40% in the last few years. They just made a big acquisition in in Europe. An Irish company, Prepaid Financial Services. I think the name speaks for itself, and it's not a pivot, just stays in the same business line. They managed to renegotiate in the middle of March to reduce their price a bit. And I think it looks like a pretty good growth opportunity, to be honest. What are your thoughts at the moment?
I remember looking at it in the depths of March and seeing the company just get hammered because there was this time there where people knew the acquisition was coming. They didn't know when it was settling, and they knew the purchase price, but they could also see what was likely going to happen with these prepaid cards and, EML's cash flow with shopping centers closing around the world, people not buying these cards for people to use in store. And I was looking at it thinking, is it or isn't it? What's happening here? Is it able to renegotiate this deal? Has it already happened? And they ended up saving a lot of money on that. And I thought that was a real impressive, I guess, stroke of luck for management to be able to pull that off as much as skill, I guess. I don't know, mate. I felt like we missed our opportunity to buy at that point, but it seems like a pretty impressive business still.
I kind of still like it. I try to think in themes as much as I can, and this really fits in the digital payments theme. There's a lot of bigger companies doing it, like PayPal and this is kind of a more fintechy approach to digital payments. So it's got three things I like, which is a huge addressable market and a growing addressable market, probably number two. Number three, it's enabled by tech. So once you've got each new customer adds more to your profit, basically. So I think it's personally, I like it. It's a buy for me, particularly after the kind of 5 to 10% drop. I've just been watching for, as you mentioned, the volumes on that European business as we enter the end of the year. But it seems like Europe's given up on economic restrictions, so it might recover quicker than Australia.
Yeah, I think for me too, it's one of those businesses that's just in such an impressive space, and it's, for all intents and purposes, it's the leader in that industry. And the more I was trying to get scuttlebutts on this. I was talking to people who use the products, and people in, for example, who manage salary sacrifice and just do all different types of things with different industries and not-for-profits. And I found that this business and its service was just dominating. It was everywhere. There was every not-for-profit is signing up with EML. So I think that's, like you said, it's a very sticky customer base. So I think if they can continue to leverage all of the reloadable cards and the opportunity there, I think it's a good business. So for me, it would definitely be closer to a buy than a sell. But again, it's one of those ones where you have to strap in for a bit of volatility. So
definitely.
you'd probably go in with your eyes wide open and a smaller position at first. But definitely, it's a good business.
Key is they make things easy. That's when you make the customer's life easy, that's when you become an important business.
Yeah, and it's because it's for so many people, salary sacrifice and just trying to manage that can be quite confusing. I mean, you'd know because you're a financial planner. You see it quite often, and people are after tax income. How do I disclose this act? What can I use it on? So there's so many different things, but EML effectively makes it easy for people to know where they can shop, know what they can pay for, get the card in the hand, and then even more innovative uses of, let's say you have a workforce of 2,000 employees and you want to issue cards to people for whatever reason that you might want to issue the card. You can manage that through EML, and that's such an easy way to go about it rather than taking everyone down to the bank and getting a card or something like that. So it's an interesting business. The last one for me is another sticky software business, which is Medicus. Medicus, you could probably call it a mid-cap now, given the valuation on the thing, but it's a software business for radiologists. And effectively what you could do with, if you had its Visage software installed at your hospital, if you were a radiologist or a doctor, you could get, say, an X-ray on your phone that's come straight across from an MRI machine, and you could look at it. You might even be able to make a call on what it is that you're looking at on the fly in real time, effectively. And so this has significant implications and, I guess, advantages for hospitals, because traditionally what happens in a picture archive system, which is where that's pretty much the default standard for every hospital in the world. What happens is, that a patient would go into a machine or sit by one, it would scan and then would send over to some sort of device where it could be rendered and you could see it. But let's imagine that, you or I are out on a run on the weekend and we do our knee and we go into the clinic on the weekend and the doctor and the radiologist isn't there. Well, then what happens, right? Do you have to wait, or is it, emergency? Do we need some sort of diagnosis of this straight away? And what they can do is they can instantly, virtually send it to someone's iPad or preferably their iPhone, and they could look at it and say, yep, it looks like a meniscus tear or something like that. And I guess the important point is here is like, well, you're thinking, well, can't anyone do this? Well, think about these images. Sometimes these images are measured in gigabytes. Right. So it's like bigger than a Netflix movie that's streamed your visual on your phone in seconds. And that's the beauty of this software. It kind of just flies over the top, and the competitive advantage comes in when it's installed in a hospital. It's almost impossible to remove because it's just so lightweight and flexible for staff to use. Have you come across this business?
Yeah, I've worked with a few clients that are in the medical space. And I think one of the big benefits, I assume they're doing it as well, is going cross-border. So you can now have people, say in Australia, looking at scans in London in the middle of the night, So you can start to use the resources more efficiently.
Yeah.
You're not going to see those orange envelopes with X-rays being carried around the streets as much anymore. It's a growth. So I don't think the software costs them anything more to create. They just have to get it installed in more and more hospitals, which they seem to be doing pretty well lately.
Yeah, and that's the thing with Pro Medicus. Once they sign on these customers, they are typically 3 to 5 year contracts, and most of them renew. But then they also benefit from the upside in the examination. So when I say examination, I mean pretty much an image. So someone comes in, they benefit incrementally from every patient that goes through that archiving system. So they're clipping the ticket constantly. It doesn't, like you said, doesn't cost them another cent. So just if I get some headline figures here, Drew, I'm pretty excited about this one. It's a company I own, I've held it for quite a long time, but underlying revenue up 24% to 56 or $57 million, contracted revenue up 13%, net profit before tax up 33%. I think the important thing here is that about 50% of the revenue, that incremental revenue that went through the business this year actually fell straight to the bottom line. So, operating leverage, this business does not require any more capital, and it's just going to keep printing money effectively.
Just sales and marketing.
That's it. Yeah. And even now the sales and marketing, I guess, mix has changed because of online and COVID restrictions. But final dividend of 6 cents per share. That's total dividends for the year up 14%, and that's fully franked. Obviously, this is not the type of business you buy for a dividend, Drew. But I think yeah, that's it. Yeah, this is just. If you're going to buy this, it's definitely firmly in your growth bucket. It's a high volatility kind of investment. If I could bring 3 more things into it that you would want to watch if you were looking at Pro Medicus, and things that we're looking at is new deals. So you touched on it. Typically with these businesses, you need to get your product in front of someone. Pro Medicus has done that for the past 5 years. They've signed up some of the biggest and best hospitals in North America, such as the Mayo Clinic. And typically with hospitals, they're much like mining companies. And typically what happens with them is that the best hospital gets a good deal, comes onto the platform, and then the next hospital that's number 2 but wants to be number 1 then joins on, and then you see this trickle down. And now what we're seeing with companies like Pro Medicus, and indeed Pro Medicus, is that it's starting to sign more hospitals as they want to be fast followers. And I guess the thing here is that management have said that the pipeline is as strong as ever, even though they're not doing conferences and events, which have typically been their number 1 channel. So that'll be an interesting one to watch out for. The second one is they've announced a new breast density software product. They haven't provided much color on this yet because it hasn't received FDA clearance, but that will be something that comes up probably in the next few months. The third one is share buybacks. So this is funny, Drew, but the company has a history of doing share buybacks. And as I'll get to in a minute, I think that would be a poor use of capital. Even though they've got it there, they don't need any more capital for the business. The shares are just way too expensive, I think, to be spending money to buy back shares. So I'd probably be almost disappointed. I can understand why they would want to do it for many reasons, but when the share price is this high, I think it's not a great use of capital. So those are the 3 things to watch. I think it's one of the best businesses on the ASX. I own it. But would I buy it now? No, I wouldn't. So I think the valuation is quite stretched. We've really run the ruler over this one, and we think a fair price to pay would be between, say, $14 and $16, and that's a fair price. And that's us, pretty ambitious multiples in there.
Market agrees. It was off a little bit today, wasn't it?
Yeah. It's still got if it was to come back to our fair value range, it would be a fair way down. But I think it's a type of business that you'd want, if you get the opportunity to buy it, like EML, you'd want to buy it and hold it for a very long period of time. But at this price, I couldn't bring myself to do it.
Like a buy in March, if you ever get another pandemic sell-off, it's one you have on your high quality list. When it hits it, you just take it as much as you can.
Yeah,
I think I agree. Great business. A client brought it forward to me a few months, maybe 6 months ago, as an idea. Great business, but too expensive at the moment.
Yeah, and that's our 2 companies, mate. Is there anything else that's caught your eye this week, or anything that you're looking forward to over the next week?
I loved CSL's result, but that's a bit boring.
We said no blue chips this week.
No blue chips.
No,
Tyro was the other one. So it's all about payments this week, isn't it? That was
yeah.
where all the providers came from. I think everyone's used the Tyro payment system. They floated, couldn't have been more bad timing for their float. Was that late last year or early this year? The biggest float of 2019. They're actually performing reasonably well. They reported wasn't great as you'd expect, but volumes compared to last year were pretty good. I kind of like Tyro. I've heard Visa explained as the infrastructure for the digital payments revolution. And as we do eventually go back to bars and cafes, I don't think many of us are going to be using cash again. So Tyro is a clear winner, and for them it's similar to Afterpay, which is acquiring merchants. So getting more and more cafes onto their system is the way that they make money.
Yeah, we're debating whether to bring Tyro into make it a focal point of this conversation. I think it's a really interesting business for those people who maybe aren't familiar with it. Every time you touch your card, next time you get a coffee or at the supermarket, have a look down at the receipt or the terminal and see what name is printed when you get your receipt. And there's a chance that it will be Tyro. And it's a really interesting business. And throughout COVID and even up until now, it's provided these weekly updates, which kind of give you a pulse check on the consumer and small businesses throughout the country, which I found really useful. Like you said, couldn't have been worse timing for the business to go to market. But yeah, it's one of those businesses that it's like the multiple that it trades at is insane. But at the same time, people love it because they know it's a clear growth story. And if you can get the chance to buy it cheap, you buy it cheap. So very interesting business. For me, there's a bunch of small caps that have reported recently, which we're really interested in. So Catapult was reported this morning, which is a sports technology business. In this, it's kind of a weird environment for sports clubs and teams around the world right now, but chalked up some pretty good results after a few years of, I guess, probably disappointment. So it was really interesting. We've got some more coming out next week. We saw Altium come out with its results this week too, which is a software business that we're familiar with, and good result.
Your favorites?
Yeah, it's one of our formal recommendations, if you like. But it was a pretty weak result, all things considered. Like it probably didn't hit all the notes that we were expecting, but I think the market expected that, so it wasn't too bad a result. I think it bounced a little bit post results. So yeah, I mean, there's so much more to get through in the next couple of weeks, mate. I'm sure we had a few recommendations for different companies. Unfortunately, we had so many that it was pretty hard to kind of manage. But if you have any comments on this, please, everyone reach out to us. We're available. I'll provide links in the show notes to Drew if you need to get in touch with him. And you're going to come back next week, mate?
Yeah, of course. Got nothing else to do on a Thursday afternoon, do I?
Well, that's a great way to put it. No,
I quite love talking about it. This is all I think about it. I've just got someone that'll listen and talk back to me.
Well, hopefully next week there's something on that whiteboard behind you, mate. Maybe it's like a secret inside share idea or something. I don't know. We'll see what comes up. But once again, mate, thanks for taking the time out.
Thank you.